Thank you for joining us today to brainstorm fraud risk for Lighthouse Cafe. I'm Adam Brown, the manager on the engagement team, and this is Rob Richardson, the audit partner.
Hello, thank you for being here. I look forward to your input during the brainstorming session. I know you're new to the profession, and this is a great opportunity for you to add to the engagement team's knowledge based on your experiences with the client.
I know we haven't worked together as a team before, so hopefully this will give you a chance to get to know us. We're going to brainstorm in a round-robin fashion. That is, we'll each share one fraud risk factor at a time. I'll document each factor we list, and we'll discuss how to address each factor after we have our entire list. Before we do that, I'll summarize highlights of last year's brainstorming session. Our firm has audited Lighthouse Cafe since 1992. The company went public in 2000, and current management has been in place for several years. Management has been cooperative, and there have not been any disputes between the company and the firm. The key members of management are Mark Wilder, President, CEO, and Chairman of the Board, and Jacob Warren, the CFO. Actually, Jacob resigned his position this past December, and Alexis Forkwood replaced him as CFO in January. Senior executives have an incentive compensation plan with bonuses contingent on two key financial growth rate performance measures. The company had a $48.6 million increase in long-term debt in fiscal 2003. 65% of this increase related to funding for the company's new mix and distribution facility. The agreement relating to the company's long-term debt includes provisions that require maintaining certain financial ratios. Rob, do you have anything to add?
No, that was an excellent summary, Adam.
Let's move on to discuss fraud risk factors for the current year. Rob?
Thanks, Adam. In terms of incentives and pressures, we know that the company operates in a highly competitive industry.
Why don't we start off by putting highly competitive industry up here then. I'm concerned about some recent press releases. Mark seems to be highly optimistic about growth plans and increasing earnings per share. So I think I'll include highly optimistic growth plans as well.
That is interesting. Based on conversations I've had with Mark and Jacob, their primary concern is definitely increasing stock price and earnings trend.
Why don't we include stock price earnings trend down in attitudes and rationalizations then?
Tell us more about these press releases.
Well, I have some recent quotes from press releases here. Let's see. Last August, Mark stated, "The results of the second quarter and the initiatives we have underway create a strong foundation for the balance of the year. Our broadening platform, which now includes both large and small U.S. markets, combined with our international expansion plans, will create growth opportunities for years to come." And in November, our business momentum continues, and our third quarter results reflect our focus on opening new stores, establishing strong off-premises relationships, and gaining greater market share. Most recently in February, he said, "I'm especially pleased with achieving our earnings guidance in a quarter in which we continued the accelerated development of company stores. We believe these investments in new company stores, including the related pre-opening costs, will provide substantial returns to shareholders." Plus, the company raised earnings expectations 4 cents throughout the year, which it just met in the end. There has been some concern that management is setting aggressive and possibly unrealistic goals for financial performance. So under attitudes and rationalization, I think I'll include aggressive, unrealistic goals.
I think you have a good point. It's also interesting to note that the company's quarterly earnings per share beat the analyst consensus by 1 cent in 9 of 10 recent quarters and equaled the analyst consensus in the most recent quarter.
Well, let's include under incentives pressures, beat earnings per share consensus by 1 cent. I think we also need to consider incentives and pressures at a personal level. Bill Anderson, one of the board members who left last April and was also involved in one of the franchise reacquisition deals last June, has been having financial difficulties. I heard around the club he was 6 months behind in his dues. So why don't we include under incentives pressures, franchisee behind in club dues?
That is an unfortunate situation. Although Mark mentioned last week that he pulled his 2 kids from private school, said he just can't afford it anymore. So it sounds like there are some financial constraints there as well.
Well, let's include CEO can't afford private school here as well.
If you have any additional insights on incentives and pressures, I'm definitely interested to hear them. We need to discuss how we want to address these issues through audit procedures. In the meantime, let's talk about opportunities.
With regard to opportunities, there has been a lot of turnover on the board recently. There were 3 new members in 2000 and 2 new members in 2003, as well as the loss of 4 other members in 2003. So I think we'll start opportunities with high board turnover.
Four board members retired. It looks like all 4 were franchise owners and remain emeritus members. You know these guys as well as I do. They are definitely going to still be involved and exert influence on the board.
Well, let's add under opportunities franchise owners influence board. As we've already mentioned, there is also a new CFO this year. In the past, Mark and Jacob have dominated decision-making within the company. I don't see this changing. I think we'll include CEO, CFO dominate under opportunities as well.
Good point. We also need to remember that Mark's ex-wife and several of the board members' families have interest in different franchises.
Well, let's include related parties' franchise interests here.
Do you have anything to add in terms of opportunities? In the meantime, we can discuss attitudes and rationalizations.
Mark has been pushing back on our recommendations regarding proper accounting for the Northern Lights joint venture under FIN 46. He is resisting consolidating the joint venture, and we've had some heated discussions. So I'll include CEO resisting joint venture consolidation here as well.
Interesting. He has also been arguing with me about accounting for the franchise reacquisitions. The company has some aggressive accounting practices in this area. The franchise industry tends to amortize reacquired franchise rights in accordance with FAS 142, while Lighthouse is recording these as an unamortized intangible asset. Mark has been arguing that their accounting is appropriate. Let's set up a time to discuss these issues further and then sit down together with Mark and Alexis.
In the meantime, let's include CEO arguing franchise reacquisition accounting here. Let's do arguing. We've already mentioned a couple of other concerns in this area. The concern that management is setting aggressive and possibly unrealistic goals for financial performance, and management's primary concern with increasing stock price and earnings trend.
Okay, thank you. I'm interested to hear your thoughts. Do you have anything to add to the brainstorming discussion?